recording now. And also turn on the closed captioning, have that available. So what we have tonight on September 28th is the session before the exam. Last week, I did post a checklist of topics to be covered that you probably want to be more comfortable with. I'm hoping you found the chapter 5 homework and even quiz a little bit cleaner, easier than chapter 4, which was pretty heavy duty. But the chapters 1 through 5 is what the exam is on. I believe there are 51 questions total, and there's 2.5 hours that you are given to take that exam. Most of the calculations, no more than 2 or 3 numbers. It's not a long problem set. It's not, like I said last week, it'll take you 45 minutes to do a problem. And that'll burn an exam pretty quick. So we're testing a lot of knowledge, but segments of that knowledge. So there's different kinds of analyses, different types of calculations, different type of ratios, that the vertical or common size analysis, the horizontal or trend analysis, and the ratio analysis. You're going to only need 2 or 3 numbers to make most calculations. Sometimes you're given 4 or 5 numbers and you have to choose the right 2 or 3 numbers, but you should be able to make sense of those as you go.
Hey, Dr. Scott, quick question. So like our quizzes, if we access the exam through Blackboard, will it launch? Is it through the My Business course as well, or is it separate?
That is correct, although the exam is on full respondus, so the cameras are active. There's an app to download if you're on an iPad, but you do have to be visible. Okay. And you get recorded, both. Okay. You can see, and there's some voice recording capability as well. So I hear, and I don't feel I'm omnipotent here and hearing all and seeing all, but I do have a pretty good feel. And Respondus does highlight and say, warning, warning, you want to take a look at this. So if eyes go wandering, if things happen, for those of you that may not have used it before, Respondus actually is pretty good. And I'm not saying that you can't cheat on it. I'm saying you don't want to. And the other fact is you're not going to have all the time in the world to really do a deeper dive saying, I remember that. Okay, let me even if you have papers to shuffle through or a book to scan, you're not going to have a lot of time on the exam. Now, you probably will finish it in 2 hours or less. I am giving 2.5 hours on the exam itself for the 50 questions. So you'll have a chance to do some checking too, hopefully. But yeah, you should be, if you're well-versed, it will go pretty quick. If you're scrambling and doubting, always go with the gut. You've heard that before. But if you're scrambling, it'll slow you down. So we want to make sure it's quick and efficient.
The last 2 things regarding the exam. So I seen in Blackboard, the grade book is out of 111. Does that stand? Is that accurate, or?
Yeah, it's actually the exam is out of 230. Because if you look at the syllabus, the 2 exams are 460 total. So each exam is 230 roughly. So it's like 220 or 240 or something in there. So it's like 4.6 points per question or 4.3. I don't remember exactly, but it's about 230. So that'll give the gauge. So because it is accurate based on what the syllabus says, it has a number of points, and those number of points based on the total number of points, you can hopefully easily do the average and calculation once you take the exam and you do the quizzes, and all the grades are in the grade book. I used to do all my grading outside in Excel. It gave me more flexibility to scale exams and make changes, drop lowest exam kind of thing, or quiz, drop lowest quiz. But for this class, everything is in Blackboard, and the grading in Blackboard is accurate for that, as my business course is accurate.
Dr. Scott, I have a question.
Sure.
On lockdown browser, like if we start doing calculations and we do our head down, it shows a message that we cannot see you. So at the end of the exam, do we write a note to you, like how many times we saw that error message, or you'll figure it out?
I will figure it out. But if you say something, and if you say, I'm just doing a calculation, and you will have the calculator accessible like you do on the quizzes. It's built into the screen. So instead of having to go down and hand crank, you will have access on the screen to see to calculate the numbers and do the calculations. So, and as I
But
said, ahead.
if I'm comfortable with the physical calculator, it's not allowed?
it is allowed. I'm not,
Okay.
I'm not gonna take that away. I don't want to, no, it's fine.
Okay.
You can use a real calculator, but yes, it may alert me and may make me take a closer look, and we may need to have a conversation at some point. Hopefully not, but
Yeah, I mean, that's other exams that I have taken for which calculations are necessary. It's usually that, if it throws a message, we write down or we email that it showed me, but I was doing calculations. So
okay, you know what? If you do get those messages, acknowledge them and let me know. I like
yeah,
that.
yeah, okay,
Good
yeah.
thought. Thank you.
Yeah. Because I mean, that's the only time I have seen an error that, you start writing and my head shows to the webcam and they show a message that we cannot see your face.
Yep.
So yeah.
I get it.
So like we did it for 605 too. So that's when we used to email to Dr. Riley that it was just I was doing calculations.
Fair enough.
Yeah.
That's a good plan. Thank you for asking.
Yeah.
Other comments or questions? Has everybody seen the summary content, the outline of material that was posted in the announcements? That's where you can see. Good. That's where you see. Yep, I can see the thumbs up. Thank you. That's the content. And as I said, most of the calculations. Thank you. Most of the calculations that are there, 2 or 3 numbers. Pretty clean. Not as bad as chapter 4 or even chapter 3. I should say module. We call them modules, not chapters with this book textbook. But anyways, you get the idea. So it should be fairly clean, and you're not going to get caught up saying, I screwed up this number up here. Three steps later, I got the wrong answer. That doesn't test anything. That tests that you screwed up in the beginning, and we don't want to catch you on that. We just want to get through and give you as much information as we can, so that you understand the concepts of how these are built. And before recording, and some folks came early, which is appreciated, we were talking about the basics of numerator, denominator, what goes in which. And when we're doing vertical analysis, the denominator in a balance sheet number is always total assets, debt to assets, inventory to assets. You want to do cash or receivables to assets. That's your percentage of inventory, percentage of receivables, percentage of debt. And on the income statement, it's not net income, which sometimes people get confused. It's net sales. That's your 100% number. That's your denominator. So your gross profit percentage, your net income percentage, your cost of goods sold percentage, your SG&A, selling general administrative percentage, all those ancillary terms on the income statement are going in the numerator, with net sales going to the denominator. I'll make one other point. We are making an assumption. I hate to make assumptions, but we're assuming when we're doing things like receivable turnover, we're assuming all sales are on accounts or on receivables. But you say, no, Walmart, restaurants, Yum Brands, you're going to whatever retailer, they're not all credit sales. There may be credit card sales or cash sales, which are considered the same. Credit card is cash, but they're not credit sales. So that number, the sales number, is a little bit deceptive, because it really officially, receivable turnover, for example, is credit sales. That's in the numerator. All right, and then average receivables in the denominator. So you're looking at that, but we make an assumption, and especially business to business, it makes sense, because most things are sold net 15, net 30, 210 net 30, 310 net 45, whatever it might be. Those are things that we look at, and we are making certain assumptions. But for practical purposes here, don't get bogged down that, well, where are my credit sales? It just says credit sales. We're assuming all sales are credit sales at that point when we calculate those ratios. So please don't get lost. And not all companies have receivables. Not all companies have a cost of goods sold. So we've talked about that too. But any problems you're given that, ask for that. And I'll give you one more tip. I'll give you one more hint. There's one question on the exam that is a none of the above answer. So when you see none of the above or all of the above, chances are that's not the correct answer. There's a ringer in there, though, that there is one that it is the correct answer. So I can't say they're all, anything time you see none of the above, disregard it. Because there is one in there. Okay, yeah, it's purposely added. I normally don't like those kind of questions, the same way I don't like true false. It's too easy to get caught up in one word, and we're not here to get you. But if you understand the concepts, you understand calculation process, how things fit together, you should be in good shape. Be able to do well. Anything else that you want to talk about? Any concepts you want to review? Anything even in module 5?
Dr. Scott,
Yes.
are we playing heavily with currency as well? Because that twists me up a little bit, because I've been.
Fair question. I guess the thing I want to emphasize most on currency is the impact on the financial statements of stronger currencies or weaker currencies.
I mean,
I'm not going to get you bogged down in the calculation, but you probably want to know what the impact is by having a stronger or weaker currency against another currency. That way,
I got you. Was kind of twisted because for the last 21 years, the euro's been kicking the dollar.
Yeah.
And all of a sudden now we're dead even. And when I'm looking at this question, and it's I can't go into detail. Let's go back to the homework. Yeah, this sucks. We got to figure out a new quiz date or something. Because we have class, we can't. Now it's a week gone. We can't talk about it.
A British pound, euro. You're right.
Yeah, the British pound. I mean, all the Turkish
Dollar's
lira.
real strong. Yep.
Yeah, but the thing that got me twisted is that if we were to purchase something, or we were to sell goods in euros, and if the euro is superior to the dollar or value more than the dollar, then the foreign currency is going to buy more dollars apparently when they bring it back to the US.
Yeah, I mean, think of the revenues and expense side. So the revenues, when the euro is stronger, that means higher revenues in euros when it compared to dollars.
Yes.
And then the expense side of it is if you have to pay off obligations in euros. So now you're caught in the middle saying, wait a minute, my dollar isn't worth as much, so I'm going to take more dollars to pay off that same bill. And as you said in the past, when the euro was much stronger. And so that kind of got inverted now because of the strong dollar. And so, I mean, look at the price of oil. Oil's come way down. Part of that is because the dollar is strong and can buy more things, and the other currencies are weaker. So that currency exchange really does play into it, which is why I'm asking you to understand the conceptual side. I'm not going to ask about derivatives. I'm not going to ask about futures contracts and all the good stuff that goes with hedging for currency exchange, because that's what companies do. They actually will buy an option on future currencies and then either let it expire and say, great, I had the option and the currency fluctuations were in my favor. I didn't need to use the option, or the fluctuations were against me. And so now I'm going to take advantage of that option because I can limit my losses when I do that. That's what you do with oil. That's what you do with gas, JP5. You also do that with commodities. You also do that with currencies. So those are things that the currency fluctuation stuff is just have a handle. I'm not going to do any heavy calculations on currency fluctuations.
Okay.
Good question.
There was another question I had from the homework. I'm trying to.
It's fine.
Hey, Dr. Scott, can you run through an example of the bad debt expense and the allowance for the doubtful accounts?
Sure. Let's talk about that. Okay, I'm gonna share. I'm gonna go onto a whiteboard and we'll have that discussion. So if we're talking bad debt expense, And we're talking the allowance for doubtful accounts. And I think you probably listened to the lectures. I hope you listened to the lectures. And you found out that we do not do adjustments to the income statement during the month. We only make a bad debt expense adjustment at the end of the month. And the two accounts we're worried about are bad debt expense and allowance for doubtful accounts. And they, you know what, the accountants being, and as wise as they are, they call that different things sometimes. But I call it allowance for doubtful accounts or ADA. And those are the two things that you adjust at the end of the month. You get things on the income statement, you get things from the balance sheet, and that's how they relate. And that is an adjusting journal entry that's made. During the month, though, you're adjusting accounts receivable, you're adjusting cash, and you're adjusting the allowance account, ADA. I'll put that in parentheses here to be clear. So when things come in, if we're looking at a balance sheet, we're going to make adjustments directly to the balance sheet. So if I draw my allowance account, I'm going to be in a situation, I'll put a T account here. Draw the number there, we got ADA. Put this here for cash. This here for accounts receivable. And for kicks, I'll put bad debt expense over here, because we'll use that at the end of the month. So what's happening? I might have $100 million, $100,000, whatever it is in receivables. And I have an offset in my allowance account, let's say $5,000. So that's roughly 5% of my receivable balance. If you say at the end of the month, my receivables really, by the way, assume my beginning receivables, my ending receivables is going to be the same. I'm going to use that as we go. At this point, if you say, well, actually my account should be 6%, not 5%. So you go over here and say my ending balance should be $6,000. We didn't do anything during the month. I started at 5, we readjusted, we extended credit we shouldn't have. We're starting to get some more chargebacks and bad debt, and people aren't being able to pay their bill. So you look at this and say, oh, well, I've got $1,000 that I need to enhance my allowance account to. So what do? At the end of the month, I'm going to adjust $1,000 to my bad debt expense. Put that over here. And I'm going to go ahead and add $1,000 to my allowance account, which is a contra asset account. It offsets. So the number I'm looking at is this number and this number to the adjust at the end of the month. And what just happened? My bad debt expense reduced my net income. So my equity goes down. My allowance for doubtful accounts increased by 1,000, which makes my net receivables go down. I went from a net of 95,000 down to a net of 94,000. So my balance sheet assets are down 1,000, but my equity is down 1,000 because I had increased expense. So that's what happens at the end of the month. But what happens during the month? Let's say I've got a $10,000 bad debt. Okay, so I get a bankruptcy note, and 10K, you will never see. Or you think you will never see. You got a bankruptcy notice, it's $10,000. You have to take that 10,000 out of my receivables, because now I should only have 90,000 there. So that's what I'm going to do. I'm going to take 10,000 out of my receivables, and I'm going to adjust my allowance account for $10,000. By the way, I'm going to go ahead and erase the previous entry here and here, and I'm going to erase the bad debt expense. We'll clear that out. Okay. So the $10,000 was adjusted during the month. You say, wait a minute. Normally, my allowance for doubtful account is a right side balance of 5,000, But right now, it's a left side balance of 5,000, which means if I printed my balance sheet, I would go ahead and have 90,000 in receivables. I'd have to add back 5. I'd have to have 95,000 would be my net receivables. Not deducting 5, but adding back 5. Because normally I deduct my ADA, but because it's got a balance adjusted here. And then something happened. Found out bankruptcy court says, ding, 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 you're a winner. You're going to collect 20 cents on the dollar. So which means, how much did you collect? What's 20% of $10,000? I got $2,000. I got a check in the mail. When I'm going to take it to the bank, I'm going to run like a hot dog. Cash it before it goes bad. $2,000 I collected, even though I had previously written off that 10,000, I got another 2,000 coming in. So during the month, I collect my cash, $2,000. And I adjust my allowance account for $2,000. So what happened? My cash went up, my assets increased, but my allowance went up again, which reduced my net receivables. I combined my receivables and ADA to get my net. So I'm in balance, my balance sheet is there, life is good. Let's do one more transaction. And we thought somebody skipped town, but I actually had a tenant like this. He was a truck driver. I thought he skipped out. 3 months later, changed the locks, and he actually came back. He's out in Colorado now. But I have got some. I still have his firearms that he's going to come pick up and some other things that he just left behind. Left a whole bunch behind. But let's say I got another $7,000. Came in the mail. I thought it was a goner. I'd written it off previously, months before, and $7,000 came in unexpectedly. So that was during the month. What am I going to do? I'm going to go in. I'm going to say, oh, let me get that cash, $7,000. Thank you very much. And I'm going to go ahead and adjust my allowance account. My cash is up. My allowance is up 7,000, which reduces my net receivables. And I'm there. Now, what's the bottom line in my allowance account? Well, I've got 10,000 on the left. I've got 14,000 on the right. My bottom line is $4,000. Actually, I'm going to draw a line there just so it's clear what we're doing. So I'm going to draw my line. My net's $4,000 right now. But then you make a calculation. Maybe we're doing 3% of receivables. Okay. And my receivables now is 90,000 because I had written that off already. But if I'm doing 3% of my receivables, well, I got 2.7K is what I should be. And I have a net of 4K. It really should be 2.7K. So I have to get, bottom line, how do I adjust this account? Well, I'm going to go in and say, what's the difference between 2.7 and 4? And I'm saying to get from 4 to 2.7, I'm going to have to adjust my allowance account, change the color on that just so we know what it is, 1.3. Well, at the end of the month, I'm going to make a 1.3 adjustment to my allowance account. And I'm going to adjust 1.3 to my bad debt expense. See, wait a minute. Bad debt expense is normally on the left-hand side. This is going to be reducing my bad debt expense, increasing my net income. And the short answer is that is correct. Because our reduction of our allowance account means we have less in the allowance account. We have more receivables. My assets have grown. So my equity has also grown to balance this out. I'm always getting two sides of the equation. So this is what's going on during the month, the allowance account and the receivables and/or cash. End of the month, we're going to be adjusting things like our bad debt expense and our allowance account for either the difference to get to the total. And the purpose behind this, let's just talk about that for a minute. The reason we're doing this is that we want to accurately portray what the sale is today or this month. You make a sale, you're not expecting to collect 100%. It would be lovely, it would be nice. And you might have such restrictive and tight credit policies that maybe you do collect 99.9% of the receivables. But if you're that restrictive, you may be losing sales to some of the less likely folks. I mean, you still don't want to lose money, but you might be cutting out 20, 30, 40% or more of your sales because of a too restrictive or too tight credit policy. So what are we trying to do? We're trying to say, you know what? It's cost of doing business. You win some, you lose some. Let's hope we win more than we lose. But I sell my stuff at a high enough margin that even if a couple of those get written off, we'll more than make up for it by having all these other folks we're able to sell to on credit. So we need to match at the time of the sale what the bad debt expense is going to be. Not 6 months from now, not a year from now, not when we get the bankruptcy notice, not when we get the understanding that the mail keeps getting returned, they moved out of town. We need to account for that now, the same way we account for warranty expense at the time of sale. Same way we account for any expense that we anticipate we have to discount it back to today at the time of sale, or in this case, the month of the sale, because we're making those month-end adjustments. So that's why we're doing this allowance account, because you could say, well, you know, this sounds like a lot of math. Why don't I just not bother doing it? And you can get away with that in GAAP if it's not material. Remember, we talked about materiality. We said, you know what? If we're going to lose a couple $100, the drive-through at McDonald's, you go through, yeah, you don't have credit. You can't just say, put it on my tab, but you might know the owner of McDonald's, and you might have a birthday party for your kid at McDonald's, and it's $200-300, and they say, send it in 15 days. And you forget to send it, or you don't send it. I don't know how long you stay friends after that, but that's $200 or $300 McDonald's is going to write off. In the scheme of things, that $200 or $300 is not a make or break. It's a receivable. You owe $300 for a wonderful birthday party that you're not going to pay for whatever reason. So what's McDonald's going to do with that? Are they going to have an allowance method or use direct write-off method? Well, if it's not material, GAAP says it's okay to use direct write-off. But 98% of the time, GAAP says you need to use the allowance method, proper matching for when you make the sale, you need to match what percentage you're not going to get. Long answer to a short question, but I'm hoping, Jesse, that makes sense.
Yes, it did.
It helps. Thank you for asking. Good question. And again, a good topic, because this is, the accountants are doing this stuff all the time. I think I told you about Health South, the rehab center here in town. They started by playing games with the allowance account. Remember how we just said, oh, it's not 4%, it's 5%. Well, if they said, oh, it's not 4%, it's 2%. Well, you just made 2% of your receivables back on your income statement. Add that to your net income. That can be pretty significant. And then you can drop it to 1.5%. And then you can drop it to 1%. And every time you're calculating, you're boosting your bottom line. But if the reality is you're at 5 or 6%, then you're in trouble. And it'll catch up with you. And it's a lie, even though it is a legitimate adjustment if it's not a lie. But it may not be a legitimate adjustment if the truth comes out that, you know what, we're cooking the books and we're just making adjustments. We're changing policies. We're extending our depreciable life on our asset. We said the car is going to work the last 10 years, but we're going to change it to 50 years. And it's not a Mercedes. So you're going through and saying, great, I'm going to have a smaller depreciation expense and capitalized assets sitting on my books, a bigger chunk. Well, if they're going to be taking a longer time to depreciate, but is that effective? Is it true? Is it reality? You're going to reduce your depreciation expense, which will increase your net income. So your net income is up and your assets are up. But that's fiction, Because the reality is the car is really being used up, the machine's being used up faster than 50 years. But because we've inflated our asset values, we have someplace else the balance sheet's going to be inflated. In this case, the equity section will be inflated because we didn't write off the expenses as fast as we could or should. We making sense? Okay. And yep, chapter 4 was a challenge. I get that. I see the chat. So I wouldn't call it horrible. I would call it a challenge. I'll let you call it whatever you want, Bill. All right. Anything else come to mind that we want to talk about?
Dr. Scott, I have a question, and I hope the answer is yes.
Yes.
Do we get okay? Do we get partial credit or extra credit?
Partial credit, extra credit on the exam? No. But
You said you'll say yes.
yeah, but I'll meet you part way.
Okay.
If you tell me after you get the results from the exam, you review your results, and you tell me, this question I interpreted differently.
Mhm.
And if that's a valid interpretation and shows you know your stuff, and you're telling me, well, based on this interpretation, this is the answer I got, why isn't it right? By the way, none of the above is probably not a good answer most of the time, but we'll have that conversation and I can give you full credit for that.
Okay.
Frankly, it's really tough to give partial credit when you say, well, what's the return on assets? And there's two numbers. Here's average assets and here's my net income. You say, can I get partial credit for that answer? In this case, nothing, it depends about it. It's right or wrong. Sorry.
Well, honestly, I like extra credits, not partial credits. So I like the idea of having a conversation.
Let me think about adding maybe 2 questions, extra credit questions on the exam. One or two that will give you a little bit of slack. And I'll take a look at that by
Okay.
Friday. See if I can add a couple of questions that might give you that cushion, say, I know I'm going to get something wrong. So maybe I'll make up for it by having a couple right. So I will take a look at that. I will post that.
Okay. Thank you.
Fair question.
Dr. Scott.
Yep.
We're looking at the PBP questions performance-based payment questions. I'm trying to grasp my head around this because this is what I deal with on a daily basis. And I've never, ever come to the point where I put a contract out for bid and someone comes back, well, this is what we're going to do it for, but you're going to pay me revenue or you're going to pay me my salary later. So where does this application take place in the real world? That's what I'm struggling with. Because when they bid on this contract, they want to build me a brand new building.
Yep.
What they bid is what they're getting paid, unless materials skyrocket like wood. So where in the real world are we calculating out what this percentage is to what their revenue is versus what the cost of labor is or material?
Okay. So what I'm hearing your question be that I got a contract or, I got an accepted contract. Here's the price we agreed on. It might be based on margin or percentage over cost, or it might be an actual fixed cost that we're associating. And revenue recognition, I think, is the concept that fits our chapter 5 that goes with that. I think everybody will want to be pretty familiar with, and the cost to cost method that we're using expenses. So we budget, you say, I got $1 million of revenue on this deal. Okay. And my costs are going to be $600,000. So what happens? Say, well, how much in expenses have I expired in the first year? Well, I did $300,000 this year. Well, that's half of the 600. So I get to recognize half the revenue.
Mm-hmm.
It's all based on cost, based on the expense side. And then next year, maybe it's a 3-year contract. Next year, I got another 150,000. Okay. Or 50,000 or whatever portion of the total expenses I'm doing, let's say 150. So another 25% of my expenses, I'm going to recognize 25% of the revenue. And that's where it's at. These performance obligations in the contract are what's key. But you're saying, what's if it's a variable cost? What if it's based on materials that are fluctuating or labor that's fluctuating? You have to be reasonably assured that you know what the numbers are, otherwise you can't record them. and that they're reasonably collectible. So what is the revenue going to be? Ultimately, you're right, there are fixed price contracts and there are variable price contracts. The problem with a variable price is you can't always predict what your materials and labor are going to fit into the scheme of things. So as a practical matter, real world experience, there's completed contract and percentage of completion method. We don't need to get into that, but just be aware that if the performance obligation is met, now you can recognize the revenue and the expenses associated with that. If you don't know what it is, you can't record it.
Okay, so this senses what fiscal handles what I don't see then.
That's what the accountants do, that you appreciate your accountants more when you start hearing about this stuff, right? So,
Okay. All right, I'm literally sitting here and I'm like, all right, I got a $100 million contract for a building and I'm going, what in the world are we doing here?
I mean, I built a $1.3 million building. The contractors make their money on the change orders. That's where the high margin is. Okay,
Definitely.
you know what? I want the automatic flush toilets, not the ones with the handle. Oh, you know how much that's gonna be? That's gonna be $412 more per toilet. Thank you very much. But that's what I want. Okay, that's what I paid. Thank you very much. I need a railing here. I don't want a wood railing. I want a metal railing. I want, we're gonna have pool tables up here. Whatever we're doing, yeah, change orders are where the margins are. But those are actually booked as the change orders happen, saying, great, here's another contract. It's an add-on to the original contract. And that bumps up the cost a whole bunch. And
Gotcha.
yes, that's where they make their money. They don't make it on the base price of building the bridge. They make it on the extra safety factors and the extra fencing and the extra tubes that people can't walk, jump, or otherwise. So,
Gotcha. And the other question I had is, this is probably redundant here based upon what Jesse asked earlier, but when we're looking at, there's something on the homework and I think I found it. Give me a second. One of these questions threw me for a loop because, where is the question? Something with 70 or $14 million, or my question is $14 million.
it's only money. Tell that to an accountant.
Yeah, therefore, however you see it. But basically it was when you get the net total and you want to look at your, not accounts receivable, what was the other one?
Net total of what? The allowance accounts?
Yeah, your trade receivables or your other receivables. And I was looking at what the net allowances are. So for one of these questions, and it was question 4 for me, and this is the one that threw me for a loop because it was asking me, what does Mandela's expect to collect from its customers as of December 31st, 2017. And with that question, I just running through the process of numbers. Do you always, when you have the net balance, do you always have to put that net allowance back in that you subtracted already?
Okay, I'm not, if you want to share your screen, you can. So you have the green button, you can do that. Bottom line is we're calculating ending balance. So we're gonna have to make those adjustments at the end for that allowance account. So what do we got? Trade receivables, other receivables. So notice the start, look at the 2 asterisks. So the trade receivables is already net of a 24, and I guess that's $24 million allowance for 2018 and a $30 million allowance for 2017. So you have to add those numbers back for your total receivables. So you're going to add 24 back to the 1357, and you're going to add 30 back to the 1615 to get your total receivables. Okay. And common size, which is vertical analysis, trade receivables. Well, okay, actually from this, you're just calculating your percentage and you're calculating the net. Same way I actually, even before we recorded, you were talking about, well, percentage of inventory. Great, I take my inventory amount divided by my total assets and I'm done. I do the same thing here. I take my trade receivables, which is the net amount, and divide it by my total assets, and I'm done. Common size trade receivables, net at year end 2018. I don't have to add anything back because it's already accounted for. So what does that net receivables mean? That's the amount I expect to collect. In theory, I don't have 1357. I have 1381 in receivables. My receivable account says 1381. My allowance account says 24. My net receivables, trade receivables, is 1357. If I'm going to be a vertical analysis on receivables, I'm going to take that 1357 and divide it by my 37,637 total assets. That's the percentage I expect to collect. And that is my vertical analysis saying, hey, as a percentage of assets, here's what my expected receivables are going to be collected. I don't expect 24 of those to be collectible out of the 1381. So, but I have 24 that I've already accounted for that I don't think I'm going to get. And then I say, well, I can do 24 out of 1381, and then I can do a percentage calculation saying, what is my net effect on a bad debt that I don't expect to collect? That's a different question. So Mondelez, which makes Oreo cookies and some other cool stuff. Wheat Thins, they were split off from Kraft, good company. All right, customers owe the company as of December 31st. So now at that, you did add back to get your total. So 1357 plus the 24 is what your receivables are. But the 1381 is not what you expect to collect. Does that make sense?
Okay. So essentially the right answer is 1381, but you're going to collect the what, 1357?
You'd love to collect the 1381. I would love for all my customers to pay me everything they owe me. Please, just go ahead. I'm going to collect it all. I'm really good. But the reality is there's a certain percentage you're never going to see. There's a certain percentage you're going to have to write off. And we're writing it off sooner than later. That's why we set up an allowance account. My total receivables are the 1357 plus the 24 is the 1381. That's my total receivables on the books. If I could have told you which customers weren't going to pay me, I would never have sold them the stuff in the first place. But I'm not that good, and neither are the most accountants. They say on average, 3% of the stuff we sell, we're never going to see the money. You don't know which 3%. You wish you knew the 3% because then you never grant credit. And that's why you have credit policies. And that's why you go through credit approval when you have a new customer that you're working with that you're selling. You're saying, I give you $50,000 limit on credit on your account, a $10,000 limit, a $2 million. It's based on what I think you can afford and pay back in a reasonable time frame for things you buy from me. If you're a new business, I'm not going to give you a heck of a lot because you don't have a track record. I don't think I'm going to cut anything out of what you have to what to get. So I'm putting on the books the full receivables. I'm deducting a portion saying, I know I'm not going to see the money for some of these guys, but I don't know which ones. And I'm coming up with a net. Does that add some clarity?
Yes. And the other question that I had is, and I'm sorry, guys, if I'm going on a wild tangent here, but a lot of things are running together for me for these last 30 days. And I'm trying to decipher what is work and what is school, because literally I'm bogged down between, but my job and this. There was a question.
Numbers at your work every day, so I get it.
Say again?
You're juggling numbers at work every day, and you're starting to get the blur.
Yeah, I can't remember which is homework, which is a quiz, which is what anymore. There was a question I had. It was about from Levi Strauss, and it was about the return, the percentage that they set aside for returns.
Yep.
Can we review a problem like that? I don't know where it was or what it was. Was it in the book? I had no idea where it was anymore.
I'm guessing you don't sell to Levi's or buy from Levi's at work, so I'm sure it was a problem here. And by the way, if any of you guys have additional questions, I mean, once the exam is open, I'm probably a little more reluctant to have the conversations. I'm happy to talk about homework,
Target.
but if you, actually, I'm guess, because it's timed and it's one sitting that you got to budget for. Yeah, you're not gonna ask me the question why you're doing the exam, because that'd waste too much time. So anytime you have additional questions and you want to sit down and chat, go ahead and reach out, let me know. We'll make time to do that.
I think it was last homework that Levi Strauss was there.
Okay. I mean, bottom line, they're gonna set aside, they're gonna say, this is the percentage I'm not gonna see. And how we were calculating, when we were in our allowance account, we were saying, oh, I went ahead and said, my allowance account, I don't think I'm gonna see in this case, maybe 4% of my receivables. I should be at $4,000 when all is said and done. During the month, I had adjustments on both sides of my allowance account. And it came out, maybe it came out to 1,000. Maybe it came out to 7,000, whatever it came out to, I've got to get to 4,000. It's like that supplies adjustment, adjusting journal entry for supplies expense. I started with $10,000 sitting in my storeroom, and I went and counted it today. There's 2,000 left. I must have spent $8,000 on stuff. Here, I'm looking at, I went back and forth and made my allowance adjustments, and bottom line, I've got $1,000 sitting in my allowance account on the right side, and I got to get to 4. That's $3,000 in additional expense and an additional ADA. My ADA goes up, my assets goes down, my expense goes up, my equity goes down, and then balance. Now, sometimes the allowance account is negative. It's on the other side. So maybe I have $10,000 on the left side of this T account, and I need to get to $4,000 on the right. Now I'm going to have a $14,000 adjustment over here just to get it where it needs to be. So right and left is kind of important. Where it ends up, how it ends up is kind of important. So be aware that you can have a total of, because if I said 10,000 here, I'd have to reduce it by 6. If I had 10,000 here, I'd have to increase it by 14 to make up for it.
Okay, so they're selling at the discounted rate, and yet they're preparing for, let's say, 5% returns on the year.
Yeah. So, and by the way, there are 2 ways to calculate this. You can take a percentage of receivables, or you can take a percentage of sales. So if you're taking, well, I got $100,000 in sales, I'm gonna have a $5,000, 5% anticipated loss or write-off out of the gate this month. I'm gonna have $5,000 in bad debt expense that I won't see. And you will adjust the allowance to go with that too. Does that make sense?
Yes.
I mean, you know you're not going to collect everything unless it's government contracts. You're not usually in a position. Sorry about that. You're not in a position to get 100% of what you bill, which is too bad. It would be nice if you could. Feeling any better? It will be by the time we take the test, I suspect.
Well, we got 10 days to cram.
You get time.
All right. Well, you've answered all my questions for the night, sir. I'll go back on mute.
Anybody else?
Oh, I do have one last one. All the questions are multiple choice. Do we have any fill-ins?
All are multiple choice, correct.
Okay.
I have one more question of other resources that I see in the chat. So other resources to use besides the videos, besides reviewing the readings, besides the notes that are included. There are, if you look in the textbook, there are actual problems that are called review problems. They're in the green in the book, and if you see them on screen, the review problems actually have videos. Every one of those review problems has a video. So if you're going through the book and you're saying, okay, this review problem, no, that's cool, that's easy, got it, piece of cake. When you get stuck and say, this review problem, this is confusing as heck, go into some of those ancillary materials. I really like this textbook. for what they include as additional materials. Yes, I like my lectures because, yeah, that's the core of what I think is important and usually what gets tested on. But also the other things, I do expect you to read the material, read the book, and even if I don't talk a lot about Sarbanes-Oxley, you're going to have familiarity with it as was in the outline. But you're going to look at that saying, well, this is confusing as heck. Maybe I could see how someone else explains it. And again, the tools, the videos that are there to explain those concepts and some sample problems and some other things. Again, if my lectures confuse you for any reason, and they very well may, hearing it a second or third time from a different angle with somebody else is actually pretty useful. And then I will share the Ben and Boz stuff, BENANDBOZ.com. They actually are pretty good. It's really an undergraduate review. I mean, we're at a little heavier level, but as a foundation, it's good information. And again, it's the terminology will be reinforced. And that might be boost your ego saying, maybe I know more than I think I do when you start listening to some of this stuff, because you probably do. And they do actually have some pretty good Excel tutorials that go with that. But what's nice about the Excel tutorials is they're all accounting Excel based. You know, assets, liabilities, equity, revenue, expenses, multi-step income statement, allowance for doubtful accounts, inventory tracking, inventory analysis, whatever it is. They go in a little different directions in some of the things, but overall, the content is pretty solid, pretty powerful. So hopefully that gives you some additional insight into resources to use. And I'm sure you have your own study groups and people you compare notes with in the program. You can do some matchmaking, let me know. But I think you probably have a good handle on some other folks. And or if you want to reach out and say, you know what, I don't want to bother you. And by the way, it's no bother, but I'd rather have 2-hour conversations with somebody else, nothing personal. Let me know, and I'll see what I can do to match up too. I'd be happy to play matchmaker. Anything else for tonight? Good questions. Thank you for asking them, because I think those are the things, obviously, I want to know what you don't want, what you want to know. Hopefully that'll help carry you and help you succeed. Happy to do so. Anything else for tonight? I'll hang on until the last person decides to depart. So if you want to hang on with some other questions you didn't want to ask in the common forum, I'm going to go ahead and stop the recording now. I will post this later tonight.